Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Cash flow is the real measure of a company's strength. And these 7 companies that I'm going to share with you guys today are printing cash. And these companies have a growing dividends even in tough markets. And the reason they do that is because they have excellent free cash flow. They have products that we depend on and buy every single year without even thinking about it. And they have been around for a very long time. Some of them are dividend kings. So I'm going to share with you guys today 7 companies that are cash flow kings. And these are the type of businesses that you should be buying if you are trying to build your own portfolio. And what I mean by that is every single portfolio out there who basically should have some stable companies that are mature businesses that are not going to fluctuate in terms of beta wise, and they're not going up 20% a day or going down 20% basically each week and so on. So this is the type of business that you want to buy and hold for a very long time without worrying about recessions and anything like that. And just the plan today is to kind of give you an overview of each one of these companies, and of course it's your responsibility to of course learn more about the companies and then take it from there, inshallah. I don't want to make the video any longer than it needs to be, so let's get started looking at these things. The yellow part is the bit that I'm going to focus on a lot more because that's the dividend streak. So that means how long they've been increasing that dividend, not how long they have been paying, but how long have they been increasing that dividend. So some of these companies are dividend kings. We will also want to check how safe that dividend is. And that safety depends on how much free cash flow these companies have. We will see also how they grow in terms of revenue side of it, in terms of EPS side of the side of things in the next few years. We'll look at the valuations. Some of them might not be cheap at this point in time, but of course, as always, we will get an opportunity. We always say this every single year. I've said over the last whatever years, there are companies that are overvalued right now, but in a few months down the line, these companies will probably become cheap. And the reason I said that is because the markets potentially might correct. And if that happens, that we get a great opportunity to buy these companies and so on. So the first company we're going to look at today is Procter Gamble. This is one of the companies that I've had in my portfolio for quite some time. It's one of the world's largest consumer goods company. It owns over 60 iconic brands like, for example, Tide, Pampers, Ariel, and Head and Shoulders, and you name it. They have a wide moat, currently 356 billion market cap, currently trading at price of $152 per share. And as you can see here, we got 2.7 dividend yield, which is quite nice. And you get £4 or so $4, and I think it should be about 23 or 13, whichever it is, because this data comes from one of the websites that I use, and this is basically come on from Simply Safe Dividend. So it's slight difference anyway. Payout ratio, we're looking at about 62%. Latest increase 5%, and the 5-year growth rate of 6%. Now, in terms of dividend streak, we're looking at almost 70 years of increase in that dividend, which is absolutely crazy. Safety 99%. The highest any company can get is 99% basically, and this company has got that. Profit margin, we're looking at about 18%, 19%. Return on equity, we're looking at about 31%. Return on invested capital 20%, and free cash flow over $14 billion right now. They expected the earnings to grow about 6%, revenue about 3%, and right now it's expensive, a little bit on the expensive side, so about 3% higher than where it should be, which is $147 per share. Now we might see that in the next few weeks, if things drop. And looking at this company here on Simply Safe Dividend, one of the things I like about this company is if you look at, for example, earnings per share, it's been heading the right direction over the last whatever years. When you look at shares outstanding, it's declining. Total sales is heading the right direction. Return on equity, return on invested capital, operating margins, free cash flow margins, everything looks good, including the debt levels. So great company, excellent free cash flow. That's the first one I want to share with you guys today. The next one is Home Depot. This company is the largest home improvement retailer in the US. They sell all types of tools, construction materials, service to both DIY consumers and professionals. So they do a lot of different things. $393 billion in market cap. Wide moat price is right now $395 per share. Again, current dividend with 2.3%, which is absolutely fine. The payout ratio is 60%. Latest increase was 2%. The 5-year growth rate of 10%, which is quite nice. 16 years of increase in that dividend. Annually, you get $9.20 for every share of this company that you own. Dividend safety, we're looking at about 87%. Profit margin, 8%, like about 9% right now. Return on equity 193%. Return on investor capital of 22%. $14 billion of free cash flow, which is absolutely amazing. And free cash flow is the money that they use to pay off any dividends. For example, they can buy back their own shares, they can pay off any debt that the company has, acquire other businesses. They can do a lot of things with that money, which is quite nice. EPS is expected to grow about 8% next year. Revenue about 4%. 15% basically downside from where we are right now. $335 per share is where they think the price should be. Right now, it's not far off. $395. So we'll see how it goes in the next few weeks or months. And looking at Simply Safe dividend, one of the things that I want to check quickly is in terms of EPS growth. So earnings per share growth, free cash flow growth. Shares outstanding is declining. Total sales is heading the right direction. Return on equity, we've already seen. Return on invested capital, operating margins, free cash flow margin, and debt levels is actually quite low, which is quite nice. So again, another great company with excellent free cash flow that you can buy today and hold it for a very, very long time. The next one is J&J. J&J doesn't need an introduction. It's been around for donkey years, and it's one of those companies that have had a couple of issues over the last whatever years. It's still sort of ongoing legal situation, but because of the size of this company, I wouldn't worry too much about that. It has a wide moat, 454 billion market cap, so absolutely huge company. You got $2. You basically right now the dividend yield is 2.6 or 2.7 almost. This cannot be right because let me just go on here because I need to check. Their payout ratio is not that high. I think that website, some of the information might not be accurate. It's about 50%, which makes sense. This is quite high. Latest increase was 5%. The 5-year growth rate is 6%, and there's 62 years of increase in that dividend. Another dividend king. $5.20 is what you get every share of this company that you own. Dividend safety 99%. Another very safe one. Profit margin 25%, return on equity 30%, and 19% when it comes to return on invested capital. Probably one of the best pharmaceutical companies out there. Over $16 billion of free cash flow. EPS expected to grow about 5%, 4% when it comes to revenue. This is not the type of companies that is going to make you millionaire next week, but it's the type of businesses that you want to own. Not all of them in the same portfolio, but maybe own 4 or 5 of these companies to sort of have a stable income as well as stable portfolio that sort of a balance, if you like, because some of these companies, like I said, they have a very low beta. So expected basically the price is basically about $172 per share. Right now is $188, so not far off from where basically it needs to be, so about 9% downside from where we are. The next one that we're looking at is, in fact, I'm just going to go back here and just check a couple of things before we move on. Earnings per share, you can see, is heading the right direction. Free cash flow, same thing. The shares outstanding is actually declining. Total sales has been heading the right direction. Return on equity, return on invested capital, operating margins, free cash flow margin. Again, debt levels, everything seems absolutely fine. And the next one is S&P Global, one that I have been talking about for the last few weeks because of this reason, because it is right now, and it has an upside of about 19% from where we are right now. One of the best companies out there. Dividend streak is actually amazing. Dividend safety is really good. Profit margin, return on equity, return on invested capital, decent. 5-year, basically the free cash flow right now is about over $5 billion, and they're expecting the earnings to grow about 12%, revenue about 7%, 19% upside from where we are, which is absolutely amazing to see. Again, we'll go back here and have a look at this company in a little bit more detail in terms of the growth side of things when it comes to EPS. So absolutely beautiful. Free cash flow looking good as well. Shares outstanding, like I said in the other video, it started to decline over the last few years. They have sort of diluted, but it's starting to decline. Again, $5.3 billion of total sales or revenue side of it to right now 14.7. Return on equity, return on invested capital is decent. Operating margin is absolutely amazing. Free cash flow is the same thing, and debt levels is quite low as well. So another great company that you don't have to worry too much about even if we end up in recession. The next one is EOG Resources. This is one of the energy companies or oil companies. Right now, as you can see here, it doesn't have a wide moat, actually. It has a narrow moat. Okay, and as you can see, $110 per share, dividend yield of 3.4, so nice dividend yield. payout ratio is quite low. The latest increase was 5%. The 5-year growth rate of 28%, which is absolutely ridiculous. Dividend streak of 7 years of increasing that dividend. You got $4 of every share of this company that you own. Safety 82%. Profit margin, return on equity, return on invested capital, really good. $4.5 billion of free cash flow, which is quite nice. They're expecting the earnings to grow. I think this is 20 because fiscal year finishes this company very soon for 2026. This, I think it was 2027. I'll double check that in a second. EPS and revenue is about 8%. They expected the price to be $137 per share. Right now is $110 per share. Let's go on here. I want to check the earnings expectations moving forward for this company. Estimates. Yeah, 2026 actually, or 2027. 2026 to finish December. Yeah, that's for 2026, so not 2027. My apologies. Let's have a look at in terms of revenue side of things. In terms of, again, oil companies are very cyclical, meaning that in terms of earnings per share is very choppy. Look at that. Sometimes it goes up, sometimes it goes down, but that's quite normal for this type of businesses. Shares outstanding is actually declining, which is nice to see, and total sales is more or less the same as basically EPS because of that cyclicality side of things. Return on equity, return on invested capital, as well as operating margin, free cash flow is actually quite good, and debt levels is actually not bad at all. Okay, the next one we're going to look at today is automatic data processing. Currently it has 118 billion market cap, and white moat $291 per share. Increased that dividend 51 years, another dividend king. So we've got 1, 2, 3, 4 so far on this list. $6.16 is what you get for every share of this company that you own. Safety 97%. Profit margin, return on equity, return on invested capital, probably one of the best out there. $4.3 billion of free cash flow. 9% basically EPS growth expected for the next year. Revenue about 6% and 5% upside from where we are. So another, that's basically undervalued at this point in time. I have a video coming up on this one here, so if you want basically these two, I'm going to do a full video inshallah. There's a few requests from some of the brothers on the Patreon. If you haven't joined us on the Patreon account, please do so. It genuinely helps the channel. So that is the next one. So let's go on here and look for ADP. Let's go and check in terms of EPS, in terms of revenue side of things. EPS looks absolutely beautiful. Free cash flow looks really good. Shares outstanding is declining. Total sales is heading the right direction. Return on equity, return on invested capital, operating margins, free cash flow. Everything looks beautiful when it comes to this company. I really genuinely like this company. I do own it in the portfolio. It's done well for me, and yeah, the fact is actually has come back. Potentially I might be adding to it soon. I'll let you know inshallah how it goes. And the final company is AbbVie. Is one of the biggest pharmaceutical companies out there. $233 per share right now. Dividend yield of 2.7. It used to be about 3, so it's gone a little bit expensive. As you can see here, it is actually expensive right now. About $184 per share is where they think the price should be. Right now it's over 233. Now basically this was a spin-off of the Abbott Laboratory, so that it sort of inherited that dividend streak. So 53 years of increasing that dividend. So they another dividend king. Dividend safety over 80% and $18.2 billion of free cash flow, which is absolutely outstanding. I really like that. This is the type, like I said, this is the type of businesses that you want to own. And again, they're all in different sectors. So this is consumer staples, consumer discretionary, healthcare, financials, energy, consumer discretionary, healthcare. So you've got a variety of companies that you could potentially own for the long run. And this is the companies, that type of business that you want to buy and sleep well at night sort of a thing. You don't have to worry about whether they're going up or down, because that's, unless something crazy happens, some legal situation happens, madness happens, these companies do not go up basically down that much, even during recessions. These are the type of businesses that do really well during recessions and so on. And the final thing I want to show you guys is the Sharia compliance side of things. Some websites will have information about these companies and say it's not Sharia compliant, but according to Zoya, according to the AAOIFI standards that they use, they all are Sharia compliant as we speak right now. And yeah, that's what I've been using. That's what I use. And yeah, if you just have to do your own research, if you believe some of these companies might not be Sharia compliant right now for whatever reason, maybe just look at their revenue and see breakdown of their revenue and see if they are or if they're not. But that's the 7 companies I wanted to share with you guys. This is the type of videos I like to share with you guys, because I just don't want everyone just to think, okay, I want to buy the high flyers. Okay, it's great to have the high flyers, you know, but at the same time you need those stable companies. And as you can see here, so I do own some of these companies like S&P Global, Home Depot, automatic data processing, where is Procter Gamble there, and so on. So I do own some of these guys, EOG Resources as well. So I do own quite a few of these companies, and the reason I do that is because I'm trying to build my own portfolio, sort of a balanced portfolio that's going to perform well over the years. I don't want to just one sector, if you like. So if you got very high flyers, then you might want to also look at some of these companies, considering some of them are actually discounted right now. Again, it's not financial advice, do your own research. But yeah, if you join us with the Patreon account, that will be absolutely helpful. If you can't, just like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.